Have you ever felt that the world of finance is an incomprehensible labyrinth? Today we are going to decipher it in a simple way. I will show you how to boost your financial intelligence with strategies inspired by the finance guru, Robert Kiyosaki. Get ready to learn how financial IQ may not only improve your finances, but also transform your life. Robert Kiyosaki, the best-selling author of Rich Dad, Poor Dad, has revolutionized the way millions of people around the world think about money. Whether you are an entrepreneur, a novice investor, or simply someone looking to improve your financial health, these strategies are essential. Let's dive into their most powerful strategies to develop financial intelligence that can lead you to financial freedom. Are you ready? Let us begin. First, we must understand what financial intelligence is. According to Kiyosaki, it is not just about accumulating wealth, but about how to manage it, invest it, and make it grow. Financial intelligence combines knowledge of economics, investment, accounting, and market understanding. What's the difference between financial IQ and conventional financial knowledge? Well, financial IQ goes beyond knowing how to save money or budget. It's about understanding how money works in the real world, how to create assets, and how to make money work for you, instead of you working for money. In a world where financial education is often overlooked in schools and homes, developing financial intelligence becomes essential. It not only prepares you to face economic challenges, but empowers you to make financial decisions that can transform your life. That's why, regardless of your age, income, or background, increasing your financial IQ is not just an option, but a necessity in these times. Through these strategies, I will show you how you can start this journey to unlock your financial potential today. Produce more money. This aspect focuses on the ability to generate money and includes factors such as the ability to make a business more profitable or create multiple streams of income. Normally, people focus on this point and dismiss the others, believing that they are not important, but this is a big mistake. At the end of the book, I will give you an example of a real case so that you better understand the magnitude of this mistake, to focus only on generating more. In this sense, the more money you earn, the higher your number one financial IQ. A person who earns $1 million in a year has a higher number one financial IQ than someone who earns $30,000 in that same period of time. An important aspect to consider is that not all people who have a high academic IQ necessarily produce money in the economic world. Kiyosaki gives as an example the case of his poor father, who, being an exceptional teacher and a very hardworking person, had a very high academic IQ but a low financial IQ. In this way, he was successful intellectually but not in business. Protect money. Someone else will always want your money and will look for ways to get it. Taxes and legal claims are a clear example of this. The key point of this element is learning to preserve and protect the money earned through legal aspects and intelligent decisions. A simple example, without going into much detail, could be a corporation, a company, which could limit the losses of your personal assets. If that venture goes badly for you, or someone sues the company, you would limit the losses to the investment put into the business, and it would not touch your personal assets. To protect your money, you must be aware of the threats that exist around it. And one of the most dangerous, as we mentioned, is taxes. There are ways to protect your capital from these, and if you know how to use them, your number two financial IQ will be solid. Kiyosaki suggests that if a person has a low number two financial IQ, they will pay more taxes. An example of financial IQ number two would be someone who pays 20% in taxes versus someone who pays 35%. The person who pays less taxes has a higher financial IQ. This type of financial IQ is not at all related to evading taxes, but rather to avoiding paying too much from the deductions that you can opt for in certain circumstances and in accordance with the laws of your country, which incentivize people who generate a positive economic change through investments with your capital. Budget money. It is nothing other than the correct administration of money and its use. No matter how much you earn, a higher IQ will be that of someone who can live well with what they earn and also use part of that money to reinvest it. He who does not keep control of his money and who spends excessively instead of reinvesting cannot boast of being financially intelligent. One of the reasons why some people who make a lot of money can't keep it is because they don't know how to budget. According to Kiyosaki, a person who earns and spends $70,000 a year has a number 3 lower financial IQ than a person who earns $30,000 and can live well on $25,000 and invest $5,000. A high level of financial intelligence is required so that, no matter how much money you earn, you can live well and invest. The key in this sense is to focus on creating a budget that gives you the possibility of living below your means and thus having a surplus or monthly profit. Before continuing, if you're liking the video, I encourage you to leave a like and subscribe so you can continue enjoying more content like this. Let's continue. Leverage your money. Once you plan a budget that allows you to have a surplus, the next step is to leverage or invest that money. Most people keep this type of surplus in the bank in the form of savings. However, this may not be the most viable alternative for you if your idea is to make that money work for your benefit, generating profits. The reason? The loss of value of that money due to inflation. This is especially true today where inflation levels close to 8% have been seen. Furthermore, some cases are more extreme, such as Argentina or Venezuela, where inflation has been reaching double digits for several years in a row. So, the interest that you may receive from your bank for having your savings in it will hardly exceed the advance of inflation, and if they do, the differential will be minimal and will not represent a true profit. The key is to keep that money in constant movement, generating income for your pocket through assets and investments. As Kiyosaki states, financial IQ number 4 is measured by investment profits. For example, a person who earns 50% on her money has a number 4 higher financial IQ than someone who earns 5% and also pays 35% in taxes on that earnings. Increase your financial information. Being well-informed and knowledgeable about finances is the last point. It is more profitable to manage our own money than to give it to someone else to do it, but for this, it is important to always stay updated, aware of financial news and trends. By developing this financial IQ, you can strengthen the rest. And you have to learn to walk before running. To obtain significant investment returns with your money, as financial IQ number 4 suggests, it is important that you master the fundamentals that govern the world of finance. Robert Kiyosaki says, "Many people struggle with financial IQ number 4 because they have been taught to hand their money over to financial experts such as their bank or an advisor. The downside to doing this is that you don't learn, so you can't increase your financial intelligence or become your own expert. If someone else manages your money and solves your difficulties, you will not be able to increase your financial intelligence. In fact, you will be rewarding others for increasing theirs with your money. If you have solid and deep financial information, it will be easy for you to increase your intelligence. But if your financial IQ is weak, then new information may become confusing and seem to have little value. One of the advantages of focusing on your financial education is that, over time, you will be able to acquire more sophisticated information, in the same way that mathematicians can solve more complicated equations after years of practicing with simple math problems. Financial intelligence is essential whether you are an employee, investor, or businessman, because the income you obtain will be directly proportional to your financial intelligence. But why is it so important to have a high financial IQ? Bad decisions can be tremendously costly, even bankrupt. Such is the case study of Sean Quinn, recognized in 2008 as the richest man in Ireland, with a fortune of approximately 4.5 billion euros, who due to a bad investment lost everything and was left with just $15,000. Between your 3 bank accounts, Sean Quinn owned a variety of businesses from insurance companies to hotels. However, due to a crisis, and his low financial IQ to protect money, his fortune was affected when he bet everything on an investment in Anglo-Irish Bank, the bank that ended up being the most affected by the crisis in Ireland. Shortly after its investment, the bank suffered monumental losses as a result of the country's real estate problem. The empire that Quinn had built with so much effort was now collapsing at a rapid pace due to the investments he made in the markets using shares of this bank. This bet, accompanied by a loan from the bank itself, was what caused him to go from multimillionaire to total bankruptcy. His careless and disastrous decision to invest in Anglo-Irish Bank before the property market boom cost him more than 1 billion euros. So that worse things would not happen, the Irish government took action and financed the Anglo-Irish Bank through contributions, thus benefiting it and nationalized it, while Sean sank into debts of more than 2,000 million euros. In the end, the new bank, already nationalized, seized his companies and properties, leaving this man's family on the street. Sean Quinn had to serve a few months in prison, and the Irish authority itself prohibited him from getting involved in the business world again for at least 12 years. Sean Quinn had a great ability to make money, but not to keep it. This sad but true story shows us that to increase financial intelligence, it is not enough to focus on a single point, but rather we must take into account the 5 that we saw in this article. Which of these 5 points do you recognize that you have to improve in your life? Let me know in the comments. I encourage you to take these keys, adapt them to your own situation, and begin your own journey toward financial success. I hope you liked the video, but above all that it helps you awaken interest in increasing your financial IQ. Don't forget that this is a summary, so I recommend reading the book and using this summary as support. If you liked it and want to learn more about investing and personal finance, don't forget to subscribe to the channel and activate notifications. Your support helps make more content like this possible. Remember, investing is a continuous journey of learning and growth. Keep learning, and above all, keep investing. Thank you for watching.